Hi, my name is Victoria DeBonis-Fortin, and tonight's training is on financials, balance sheet basics. So thank you for joining me here tonight, and we're going to go through a brief overview of understanding the balance sheet. This training is meant for small business owners that are just learning and understanding their businesses and basics as far as balance sheets are concerned. And we'll show you a little bit about what would happen when you're looking at if you possibly are looking for investments and you want to invest as well. So we'll show you a few things in regards to what you might see on a public or larger, company scale. So with that, I'm going to go ahead and share my screen, the balance sheet, basics to get started. And just to give you a little bit of information about me, my name again is Victoria DeBonis-Fortin. I started my first company at the age of 16. And when I went to college, I discovered that because I'd been in business since I was 16 years old, I really understood and got what accounting was all about and how useful it was for owning a business to understand what was actually happening. So I discovered that in school, got a bachelor's in accounting, a master's in business administration, and then sat for my CPA license and became licensed for 4 years. After that, my license became inactive as I became more of a corporate operational controller and CFO. So that was about 30 years ago. Since then, I've been into many, many different companies, 15, 18 different companies with very diverse backgrounds, which has been fun and exciting, learning something new all the time. What I am very good at is understanding how businesses operate. I've done multiple accounting and operational systems implementations with all kinds of software. Right now, primarily for smaller businesses, I do use QuickBooks Online. I help with NetSuite implementations, and I have done complete multi-subsidiary setups of NetSuite. I currently own Valid Solutions Consulting. I have anywhere between 5 and 8 clients at any given time doing outsourced controller and CFO services for my clients. So with that, we'll get started on the balance sheet, understanding a little bit about what it is, what you're looking for, and just in general, what is on there. So with the balance sheet, you have assets on one side, you have liabilities and owner's equity on the other side. And as it implies, it must balance whatever's on one side has to be on the other side. So it also, the report covers a specific point in time. You will see these reports written as with an as of date, balance sheet as of 12/31/2020, as opposed to for the period of as you would see in an income statement. So you always want to make sure it's a period in time, it's a snapshot. It's usually done monthly, quarterly, or yearly, matching the income statement and statement and cash flows are the other two statements that you're looking at, the three of them together to make sure that everything is equals the other ones. And what it does is it lets you know where you are at the moment that balance sheet is run. That could be ever changing because your income is also going to be ever changing with your company, and that will affect the changes on your balance sheet as well as cash, paying bills, receiving money, all of those things will constantly change your balance sheet. So this financial document really depicts 3 areas of financial health: your assets, your liabilities, and your equity. You always want to make sure when you're running all of your financial statements that if they're exactly at the same point in time with the same method of accounting, either cash or accrual, otherwise there's a good probability that your numbers won't match. And this has happened to me plenty of times where we'll run one financial in one accounting method and another one in another, and they don't match, and everybody's pulling their hair out only to discover that one was run in cash method, the other one in accrual, and that's why everything doesn't tie out and make sense. So with that being said, what are they? Assets are what the company owns. Liabilities are what the company owes, and what's left is the shareholders' equity. It's the stake that the owner or shareholder has in the company. It's net worth, in other words. If you've ever done a personal financial statement, that's what your net worth is. So that is important to know about that. Assets. What are assets? Assets are anything that the company owns that has value, even if you owe money for it. Basically, after you've paid or liquidated whatever it is that you have in your company, that asset is worth cash. Any unsold resources or goods owned by the company, like inventory, for instance, or desk chairs or anything like that, is an asset of the company. A current asset is something that can be turned into cash within a year. So cash or current or cash equivalents. So these days you're hearing a lot about cryptocurrency. That would be a cash equivalent. So that would fall in that area in current assets on your balance sheet. Prepaid expenses are expenses that are paid for in advance but not used yet. Some good examples are insurance premiums, subscriptions, consulting fees, or legal retainer fees that are paid for. Let's say you pay a consultant by the quarter, but they haven't earned or had the expense of everything that has been done. Maybe it's for a project. You wouldn't want to expense $10,000 in 1 month. You'd want to prorate it over the period of time that you're actually getting services or the bills from that consultant. The same thing with, let's say, insurance. You have a $12,000 insurance policy that you pay for the year in March. You would only want to expense $1,000 a month on your income statement. So the rest of it, so $11,000 in the month of March would go in the prepaid section, and every month $1,000 would be expensed from the prepaids into your income statement, thereby showing you a more reliable methodology of how expenses are actually being used by the company, not just cash. Accounts receivable, if you're owed money, if you have sell on credit, you have clients or customers that owe you money, that would leave you with having accounts receivable. Accounts receivable also can be employee advances, if you advance your employees some money. If the company, if you have two different companies and one company borrows from the other, there might be an accounts receivable from the other company that borrowed the money. So there's different types of accounts receivable that also could be put here. If you as the owner owe money to the company, it could be an accounts receivable here as well. Inventory are products that are not sold yet. As we discussed on the income statement, you only want to record as an expense the actual cost of goods sold at the time you sell them in proportion to the sale of the product. Whatever's not sold would go into inventory. If you are making your inventory and there's raw materials that go into the product that you're making, that would be part of inventory. Marketable securities are short-term stocks, bonds, CDs, or commercial paper, anything underneath a year, 12 months or less. Anything more than that would go in your long-term section. Cash advances that, as we had talked about, that get paid to employees would also go here, and refunds and credits that you're expecting that haven't been received that's owed to you would also go in current assets. Now you might be asking, why do they break up current assets from long-term assets? Because there are some formulas that are used in the industry, especially by banks, lenders, even other companies looking for credit worthiness. When you are looking at stocks for certain companies, you're going to want to know some of the ratios called financial ratios. We will be doing a separate training on financial ratios. There's quite a few of them, and once you understand the basics of balance sheets and income statements, it'll give you a better idea of what those financial ratios mean. Long-term assets are anything that's not easily converted into cash within a year. And you might have, anything that's more than 12 months would go into this long-term section. Fixed assets, frequently referred to as property, plant, and equipment, or PPE, they're tangible assets. It's land, buildings, equipment, furniture and fixtures, and leasehold improvements. So you say, well, what are leasehold improvements? Well, let's see you move into a office, and we call it a vanilla box, or a plain office with no offices set up in it, and you need to put some construction work in it. It's not your building, but you're going to improve it. It's called a leasehold improvement. You wouldn't necessarily want to expense $20,000, $30,000, $50,000 that you put in there over that 5-year lease that you're there. So you're going to capitalize it in leasehold improvements and depreciate it over the period of the lease that you're leasing that particular office for. Intangible office assets would be things like patents, copyrights, and trademarks. Those are sometimes good for a certain period of time, and basically you're going to do what they call amortize those off as that time elapses. So then it brings us to goodwill, and a lot of people are like, what is goodwill? Generally, you'll see this in pretty much larger companies and private and public larger companies, but occasionally you'll see it in a small company. And generally this happens when you purchase or buy out somebody else's company. So how does goodwill get put on the books? Well, the next slide is going to give us a little bit of an idea of explaining this very briefly. Again, it can be much more complicated, and this is a very simplified version because actually it's a little more, there's actually some other parameters that go into it, but I just wanted, for the sake of clarity and ease of understanding, giving you a brief description and calculation to show you how goodwill works. So it's the consideration paid plus the fair value of the non-controlling interest, assets acquired minus liabilities assumed, ends up with a net worth. I know that's a lot to say, but it's the goodwill is really the amount assigned from the difference between the purchase price paid by the acquirer and the amount that cannot be assigned to any individually owned or identified assets or liabilities acquired by the transaction, or the premium paid for the business. So here's a brief example. This particular company had $10,000 worth of accounts receivable that the new owner will be able to collect from the clients of the old owner. There's $50,000 worth of inventory left that the new owner will acquire. There's a building that's available that still has $30,000 of worth on the books, as well as a trademark that has $70,000. So there's $160,000 worth of assets, of which there's $5,000 still owed, and the loan on the building is still $50,000. They've just been paying an interest-only loan. So the book value of this company is $105,000, but the old owner, or the person who's selling, has convinced the new person to pay $200,000. Why in the world would anybody pay that? Well, a good reason, lots of good reasons. One of them is that there's a trademark here that's worth $70,000 in and of itself. So there is some goodwill, not just the intangible asset on the books, but there's some goodwill that goes with that brand, with that trademark. And because it's been there for a while and it's well known, there's some goodwill that comes with that. There also might be a customer base. Maybe this particular company has, 50,000 customers that know who this company is and will continue to buy from this company. So there's some goodwill there. Well, there's no way to attach a value to that. So the value becomes this premium paid for the company. So $95,000 would go on the books as goodwill if it gets purchased for $200,000. Now, there are some other changes that may happen with the goodwill, which becomes fair market value, which is another whole part of this exercise. But we're not, maybe increased or decreased due to fair market value, but we're not going to get into the details of that in this particular explanation because it gets too technical at that point. However, I do want to let you know that many years ago, and I shouldn't say many, but probably 20 years ago, goodwill used to be amortized over a 40-year period of time. That's how valuable it was. Now goodwill is pretty much amortized for the most part according to generally accepted accounting principles, or GAAP, for a 10-year period of time. Now we're going to go into liabilities. Liabilities are anything that's owed by the company, and current liabilities are within a year's time. So you'll have your regular accounts or trades receivable, your vendor bills, your notes payable, any kind of current portion of a long-term debt, any capital, or now, as of the last 2 years, operating lease payments will show up as a liability. Again, this is the first 12 months of that. If you have a 5-year lease, the rest of that lease payment will show up in the long-term lease payments or lease liabilities of your balance sheet underneath your liabilities. Accrued expenses, well, this is kind of the flip side of your prepaid expenses. An example of this is, let's say that you have a salary that is earned in the month. Let's say commissions are earned in the month of January, but they're not paid till the middle of February. Well, you really want to truly show the expense of the commissions or salaries for January in the month of January. So you're going to accrue them, but you're going to pay them in February. So you would use this liability account of accrued expenses to show any accrual. The same thing with things like paid time off. Let's say you have employees, you have 10 employees that earn paid time off every month. They earn a certain amount. You want to make sure you accrue that expense in the month they earn them. And then when it's paid, then you would, the expense is already on the books. You would just go to accrued expenses and basically put the cash against that accrued expense at the time that you actually pay it. Again, these are a little more technical type of mechanisms that are in place that a little bit larger companies may use. Smaller companies may not bother using them, but you may also see this information on some other financial, whether you're acquiring a business or a larger business or looking at financials for investment purposes, whether it be a public or a private company. At least you know what you're looking at when you see something called accrued expenses. You may also see taxes, interest, salaries. There are many different types of current liabilities, but most of the time these are things that are due within a year's period of time. The next area is unearned revenue. Unearned revenue are things like, the biggest one that comes to my mind is things like subscriptions. Let's say that you, like I sell you a subscription for $100 a month as a membership to my educational site. But you pay $1,200 at the beginning of the year. Well, I'm not going to take into that income. I haven't earned that $1,200 yet in January. I've only earned $100. So I would put a sale of $100 and the rest of the $1,100 in unearned revenue. And every month I would take $100 out and put that as a sale on my books and leave the rest in unearned revenue. Another unearned revenue you'll hear a lot about are things like installment payments, where you may not all be earned yet, and it's earned over a period of time. So this is where you would put unearned revenue. Customer deposits falls under the same area, where you may have a customer pay you upfront a deposit on, let's say, a job you're going to do 2 months from now or a month from now, but you haven't earned that job yet. You haven't even given the customer an invoice yet, but they put $10,000 down. Well, you would put it here because it's still a liability until you've completed the job. So that's why you would see something like customer deposits falling under liabilities. Long-term liabilities are anything that is owed over a year. It would be any kind of a notes payable, maybe just the short-term portion of a longer note, the first 12 months being under current, the rest being under the notes payable. Long-term debt like mortgages. In larger companies, again, or financial institutions, you might see bonds payable. Some older companies may still have defined benefit pension obligations. Long-term leases, whether they be capital or operating. Deferred tax liabilities, liabilities you know that are coming, but you may not have to pay them today, but you want to start putting them in here, maybe for your quarterly tax purposes or things like that. You may want to be putting them here every month, but you know you're not going to have to pay them until 3 months or 6 months or whenever your quarterly payments are due. And then contingent liabilities are any kind of legal liabilities that you may see coming down that you may want to put on your books just to have a placeholder and know that you may have to pay a liability. It's pretty rare to see this, but I thought I'd put it there just in case you might see it if you're looking at investments and you're looking at some public records of investments, occasionally I think they have to disclose contingent liabilities. Sometimes they'll be on the balance sheet, sometimes they'll just be in the footnotes. So just in case you see that, it's kind of a little bit of unusual. Okay, equity is the next area that we're going to talk about, which is the other half of the bottom side, or the other side of the scale, I should say. So it's the value of your assets after deducting your business liabilities, or again, that net worth number. You have all the rights to the items of value within your company, but you also take responsibility for your liabilities. So your net worth is the difference between what is owned and what is owed, and it should be positive. If it's not positive, for a short period of time, you might be able to have it not be positive, maybe for a month. But if it continually is not positive, your company very well could be insolvent. It essentially means that you're basically taking, or whoever runs this company is taking all the profits out of the company and not leaving any profits available for the company to continue to run. So that's usually a very good indicator. If you see negative equity, the viability of the company is not going to be very long if it continues over a long period of time. Okay, so let's see, equity types. Business equity, the value of your assets after deducting your business liabilities. So there's several different types. You've got owner's equity, which generally you'll see with a sole proprietor or single member LLC, often referred to as an SMLLC. Stakeholder or member or partnership equity, you'll see with two or more partners in a business together. There may not necessarily be stock issued. Generally, the partnership agreement is written in percentages of who owes percentage-wise what part of the company. And that pretty much is shown in, that's usually like in an LLC, you'll see that. Then you have your S Corp or your C Corp, where actual shares are issued representing a percentage of the ownership of the company. And that's referred to as shareholders' equity. And there's several types of stock that are generally issued. You'll see common stock, which is capital that's contributed, many times with a par value of $1. Par value is assigned to the stock by the company's charter or articles of incorporation. It is pretty much a number or a figure that is arbitrarily assigned to that piece of paper or to that share of stock. It usually has voting rights, and there is a residual claim to the company's assets after it's basically liquidated. So all the bills have to be paid first, but then whoever the ownership has of the stocks, depending again on the percentage, that would be the amount that you would get of what's left over according to the percent that you own. Preferred stock is a slightly different type of stock, a little different. There's no voting rights, but there is some preferential treatment there. And what that is that generally you're guaranteed a certain dividend every year. So maybe it's $5 per share of stock that you own. And if it's not paid that year, then it starts to accumulate. So maybe you didn't get paid the $5 in the first year because the company is just starting up. And the second year, they really need that $5 per share to continue operations. But by the third year, they're doing really well. Well, it's not that you'll just get paid the $5 a year. You would get paid the $15, whatever has accumulated as in dividends. And you would get paid that first before any other distributions are made. So you have some preferential treatment in the amount that you would get out of any of the distributions or dividends of the company. Additional paid-in capital, what is that? Well, remember before when I told you common stock was worth $1? Well, what happens if people start paying $10 for that stock? Where does the other $9 go? Well, the dollar goes to the common stock. The other $9 is really their funds raised by the business by selling equity. That $9 goes into this combined contributed surplus called additional paid-in capital. So essentially, if the shares, I was using $10, $9, the other $9 goes into PIC, or the paid-in capital. There are sometimes when companies want to buy back some of the percentage of their company or some of the shares of their company just to gain a little more control. So let's say they've sold a bunch, but now they're like, okay, well, there's too much control being distributed to the shareholders. We want to get some of our control back. A lot of times they'll buy back shares, but it's bought back by the company, not by individuals. Anything bought back by the company, it goes into something called treasury stock. So occasionally you'll see that treasury stock will show up. So then what's left? Then there's retained earnings. Retained earnings represents the cumulative net income since the company was formed, minus any cumulative dividends that were declared and paid, and that's not been distributed to shareholders or owners. That's the money that's left that's sitting there. So let's say a company earns $100,000 for 3 years. $300,000 is sitting in retained earnings, and they paid out $50,000 worth of dividends. You now have $250,000 in retained earnings, not including the current year's net income. The current year's net income at this point is $50,000. So there's two different ways you'll see this presented on a balance sheet. You'll either see retained earnings combined with the net income from the current year. Not my choice of the way I'd like to see financial statements done, simply because it's very difficult then to tie out net income with the net income of the income statement. And it's all rolled up together as $250,000, or seeing it separated $200,000 in your previous year retained earnings and net income for the current year. That net income for the current year should absolutely match what your income statement number is at the very bottom line that we talked about in the last training. If those two numbers don't match, you've got a problem, and you got to figure out whether reports haven't been run properly, the timing isn't right, something is not right when those two numbers don't match each other. So they always should, net income for the current year on the very bottom of your balance sheet should always match your net income statement that you've run for that same period of time with the same accounting method. So with that, we'll have some examples very shortly here to show you what that means. Equity compensation. So sometimes I'm sure you've heard of something called sweat equity. It's offering employees a percentage of the company profits or ownership in exchange for a lower salary up front. So sometimes what happens is people go into business and then they have a really great partner, but the partner may not have as much money to put into the business to buy in or to buy stock or to buy a percentage share of the company. So they agree to either lower their salary or not take any salary for a period of time as compensation to buy into the company. And that's where you see people getting into some companies with something they call sweat equity. It's usually done in a lot of professional practices. People have student debt for becoming lawyers, doctors, dentists, veterinarians, any of those types of trades, but yet they have this amazing skill that's worth a lot of money, and maybe they don't need to make the huge salary up front, yet they're worth it. A lot of times agreements, buy-sell agreements, different kinds of agreements are drawn up using equity compensation as a means for people to, these professionals to get some ownership in a company. It also can happen with other companies that are startups that are just beginning. If there's not a lot of money up front, but maybe somebody comes in with really great skills and marketing or accounting or financial, or even CEOs will sometimes come in with sweat equity to enhance the business, not get paid as much money, but they're actually working for their equity share. So here's a little exercise just showing how retained earnings can be calculated. When we were talking about before that you might have retained earnings all being in one number. You would need two sets of financials, the beginning year or period financials, generally the beginning of the year and the end of the year. You would need that ending number minus any dividends that were paid out. You subtract out that retained earnings, and that'll give you your net income. Because sometimes net income, if it's buried within that retained earnings number, it's a little tricky to extract that number out. So this is kind of a little formula on how you would do that. Business entity structures, we're going to go into that in another training in much more detail at another time, because there's a lot of details explaining the whys, the pros and cons of these, but I thought that I would hit and let you know that there are different types, and I'm sure you do, Most of these are set up for tax purposes, but it also does become a way of understanding how to get your business set up. So it kind of goes hand in hand with business setup. So sole proprietorships are very easy to start. Generally, you go out, you get a DBA from your state, then you go get an FEIN or federal employer identification number from the IRS. You then can go open up a bank account, which I highly recommend that you have a separate bank account the minute that you start a business. And generally your income and expenses are reported on a Schedule C on your 1040. The same thing with an SMLLC, which is a one-person LLC. You'll see that when you go ahead and apply with the IRS, if you only list one member, you'll see that it becomes a disregarded entity. Doesn't mean anything other than you just still file instead of filing a separate tax return, you would just file the Schedule C similar to a sole proprietor. What happens in that is that your liability is definitely less than being a sole proprietor, but again, we'll cover that in pros and cons. An LLC, a limited liability company, can have several partners. And generally, if you have 2 or more partners, you're going to file a 1065 partnership. The income from the company will flow through to each partner's tax return, and each partner will be taxed according to their tax bracket. There's no taxes really paid by the LLC. It goes to each owner. There's an LLC tax as an S corporation, then you're going to do an S corp return, but again, K1s will be distributed to each owner. S corporations and C corporations, again, there's more detailed training on this in the future with understanding how these returns are done and what the purposes of the tax structures are and what the benefits and, again, pros and cons of each one of these types of tax structures. Again, it depends on your size and what you're trying to accomplish. So with a balance sheet, there's a couple different ways that these are laid out. As you can see, there's a vertical layout, which is assets, liabilities, and equity kind of stacked. And then a horizontal where they're like a scale where they're on both sides. So you'll see them presented in 2 different ways. The main thing is that, again, you're going to see that, again, you can show numbers either way with what you have, what you owe, and what you're worth. And those numbers go back and forth in those directions again to balance. And here's an actual balance sheet, which I thought was important to show so that you can kind of see a little bit more now that we've gone through each one of those little sections. This will be much more meaningful information for you. So with that being said, as you can see, this balance sheet has an as of date. The assets are at the top. There are current assets and long-term assets totaling up with a figure. Then there is current liabilities and long-term liabilities with a figure, and then owner's equity, including retained earnings, which in this case includes the current year's net income. As you can see, these 2 numbers equal each other. So the first thing you want to do when you look at a balance sheet is make sure that the assets and the total liabilities and owner's equity, the minute you open it up, those 2 numbers equal each other. The second step would be look at your retained earnings, see if you can find your current year's net income, if there's a net income number. If not, you may have to do a calculation to figure out what that retained earnings number or what that net income number is. And it may be by looking at the previous year's balance sheet from the company. That number should equal the very last number as from our last training with the net income. Those numbers should match each other. If they don't, you're not looking at reports written or recorded or run off at exactly the same time with the same accounting method. So with that, that's the end of this training for today. Contact me for more information at validsolutionsconsulting.com, Women's Business Strategy Network. We're on YouTube with Women's Business Strategy, with both companies actually, and YouTube with Women's Business Strategy Network. This video will be posted on YouTube under Women's Business Strategy Network. And feel free to contact me with any questions that you may have. I'll talk to you soon. Please subscribe to my channel, Women's Business Strategy Network, and my Facebook page. Would love to have you. Thanks very much and have a great evening.